Welcome to this deep dive into the world of home equity. For many homeowners, the house is not just a place to live, but the largest financial asset they will ever own. Over time, as you pay down your mortgage and property values in your area rise, you build up a significant amount of equity. This equity represents wealth that is locked away in the walls and foundation of your home. The big question is how to access that wealth when you need it. Today, we are exploring two very different paths to liquidate it. We are comparing the traditional home equity line of credit, commonly known as a HELOC, and the innovative alternative known as a home equity investment or HEI. Most people are familiar with the concept of a loan. You borrow money, you pay it back with interest, and you make monthly payments until the debt is gone. This is the foundation of the HELOC. A HELOC works much like a credit card that is secured by your home. You are given a credit limit based on your equity, and you can draw funds as you need them. However, because it is a loan, it comes with a monthly obligation. For many homeowners, especially those on a fixed income or those with fluctuating monthly earnings, adding another bill to the pile is the last thing they want to do. This is where the home equity investment enters the conversation as a potential game changer. An HEI is not a loan. It is an investment. When you enter into an HEI agreement, a company provides you with a lump sum of cash today in exchange for a share of your home's future value. Because it is not a loan, there is no interest rate. More importantly, there are absolutely no monthly payments. This is the primary reason why homeowners are increasingly turning to HEIs. Imagine receiving $50,000 or $100,000 today and not having to worry about a single monthly bill for the next 10 or even 50 years. This provides an incredible amount of breathing room for your monthly budget. Let us break down the mechanics of how these two options function over time. With an HELOC, you typically enter a draw period, which often lasts 10 years. During this time, you might only be required to pay the interest on what you have borrowed. This keeps payments low initially, but once the draw period ends, you enter the repayment period. This is when the full balance plus interest must be paid back, often resulting in a massive spike in your monthly payment. Additionally, HELOCs usually have variable interest rates. This means if the central bank raises rates, your monthly payment goes up automatically. You are at the mercy of the market and the economy. With a home equity investment, the experience is entirely different. You receive your cash, and then you simply continue living in your home as you always have. You remain the owner on the title. You are responsible for taxes and maintenance. The investor is a passive partner. The settlement happens later, usually when you decide to sell the home or at the end of a long term, such as 50 years. At that point, you pay the investor back the original investment plus a percentage of the home's appreciation. If your home value stays the same or goes down, the investor shares in that loss. This means the investor is taking on risk right alongside you. The qualifications for these two products also differ significantly. Banks are very strict when it comes to HELOCs. They want to see a very high credit score, a low debt-to-income ratio, and a steady, predictable income. If you are self-employed or have a lower credit score, getting a HELOC can be nearly impossible. HEI providers, however, are more interested in the value of the property than the credit score of the individual. While they still look at credit, they are often much more flexible because they are investing in the asset, not just your ability to make a monthly payment. This opens doors for many people who have been turned away by traditional banks. So when does it make sense to choose one over the other? A HELOC might be the right choice if you have great credit and you only need small amounts of money over a long period. It is also good if you have the cash flow to handle fluctuating monthly payments. On the other hand, an HEI is often the superior choice if you need a large lump sum and want to protect your monthly cash flow. It is perfect for debt consolidation, home renovations, or even starting a business where you do not want the burden of a new monthly debt during the early stages. In summary, the choice between an HEI and an HELOC comes down to your personal financial goals and your comfort level with monthly debt. If you want to tap into your home equity without the stress of a new monthly bill, the home equity investment offers a path that was not available to previous generations of homeowners. It is a way to make your home work for you, rather than you working for your home. Take the time to evaluate your equity, look at your long-term plans, and decide which of these tools will help you reach your financial freedom the fastest. Thank you for joining us for this deep dive into home equity solutions. Every homeowner eventually reaches a crossroads where the value of their property far exceeds the balance of their mortgage. This buildup of wealth is often referred to as a dormant asset because it sits quietly in the walls of your home without providing any immediate liquidity. Historically, the only way to tap into this wealth was to sell the house or take on more debt. Today, the landscape has changed dramatically with the emergence of the home equity investment known as HEI, which stands in stark contrast to the traditional home equity line of credit known as a HELOC. Understanding the fundamental differences between these two financial instruments is essential for anyone who wants to manage their personal wealth with precision and foresight. Let us begin by examining the structure of an HELOC because it has been the standard for decades. When you open a HELOC, you are essentially asking a bank to trust that you can pay back a loan based on the collateral of your home. The bank looks at your credit score, your history of employment, and your debt-to-income ratio. If you qualify, they give you a credit line. The primary advantage of an HELOC is its flexibility during the draw period. You only pay for what you use. However, the hidden danger of an HELOC is the variable interest rate. We live in an unpredictable global economy where interest rates can climb rapidly. When rates go up, your monthly payment increases, which can put an unexpected strain on your household budget. Furthermore, a HELOC is a debt obligation that appears on your credit report, which might limit your ability to get other loans for cars or business ventures in the future. Now, let us turn our attention to the home equity investment, or HEI. This is a radical departure from the traditional banking model because it is not a loan at all. Instead of acting as a lender, the HEI provider acts as a silent partner in your home. They provide you with a significant lump sum of cash up front. In exchange, they receive a share of the future value of your property. The most revolutionary aspect of this arrangement is the total absence of monthly payments. There is no interest rate to worry about and no monthly bill to pay. This creates the unique financial cushion for the homeowner. You can use the cash today to pay off high-interest credit cards, fund a child's education, or renovate your kitchen, all without adding a single dollar to your monthly expenses. Because there is no monthly payment, the qualification process is often much more inclusive, focusing on the quality of the property rather than just the credit score of the borrower. The long-term implications of these two choices are also very different. With the HELOC, you are committed to a repayment schedule. Eventually, the draw period ends and you must pay back the principal plus interest. This can lead to a massive payment shock. With an HEI, there is no ticking clock in the same way. You typically have a long window, often up to 30 years, to settle the investment. This usually happens when you sell the home, refinance your mortgage, or reach the end of the term. The amount you pay back is tied to the value of your home at that future date. If your home appreciates significantly, the investor profits alongside you. If the